All right, let's talk about taxes. Do you ever get that feeling that you're just paying way too much? Well, in this explainer, we are going to unlock the updated 2026 strategies to help you legally, and that's the key word, keep more of your hard-earned money. We're not talking about sketchy loopholes here. This is all about knowing the rules of the game and playing it smart. Let's dive in.
So let me kick things off with a question, and I want you to be honest with yourself. Are you overpaying your taxes? I'm willing to bet that for a lot of you watching, the answer is a big, surprising yes. It sounds kind of crazy, right? But it's true. Most Canadians give the government more money than they need to, year after year. But here's the really good news. Avoiding it is 100% legal. In fact, the government has actually created tools specifically to help you. You just have to know they're there.
Okay, first things first. Before we get into any strategies, we need to tackle the single biggest, most common myth out there when it comes to taxes. You know that awesome feeling you get when a big tax refund hits your bank account? Yeah, we need to talk about that.
So here's the hard truth. That refund, it's not a gift, it's not a bonus, it's literally just the government giving you back your own money that you overpaid throughout the year. Think of it this way. You gave the government an interest-free loan. Your employer takes a bit of tax off every paycheck, and they often take a little extra just to be safe. That refund is just them settling the score. Imagine what else you could have done with that cash over the last 12 months.
So, if we're going to save you money on taxes, we have to get on the same page about how they actually work. And that means busting a huge myth that scares a lot of people away from earning more.
Have you ever heard someone say they didn't want a raise because it would bump them into a higher tax bracket and they'd actually take home less money? Yeah, that's a total myth. It's not how it works at all, thanks to something called a marginal tax system. That higher tax rate, it only applies to the dollars you earn within that new bracket, not your whole income. I'll say it again. A pay raise will never, ever make you take home less money.
The best way to think about this is with the piggy bank analogy. Picture your income filling up a series of piggy banks, one after another. For 2026, that first piggy bank holds about $58,500. Every dollar in there gets taxed at the new, lower federal rate of 14%. Once that bank is full, your income starts spilling into the next piggy bank, which gets taxed at a slightly higher rate. It just keeps going like that. Simple, right? And it gets even better. Before a single dollar of your income gets taxed, the government gives everyone a free pass. It's called the basic personal amount. For 2026, that number has gone up to $16,452. That means you can earn that much money without paying a single cent of federal income tax. It's a tax-free head start for every Canadian.
Okay, so now that we've got the basics down, let's talk about the fun stuff, the tools. These are the powerful accounts the government has literally designed to help you save on tax. This is your toolkit. We're talking about the big three tax-advantaged accounts. You've probably heard of them: the RRSP for retirement, the FHSA for your first home, and of course, the TFSA, which is a powerhouse for tax-free growth. Honestly, understanding how these three work together is probably 90% of a great tax strategy.
So let's put the RRSP and the FHSA side by side. The big thing they have in common, they both give you a tax deduction right now. For every dollar you put in, you get to subtract that dollar from your income at tax time, which means a smaller tax bill. The main difference is what happens when you take the money out. With an FHSA, if you're using it for a first home, it comes out completely tax-free. An RRSP, on the other hand, is generally taxed on withdrawal.
Okay, now for the TFSA. And this one's a little different. You don't get that immediate tax break when you put money in. But, and this is a huge but, the magic happens on the back end. Any money your investments make inside a TFSA, interest, dividends, capital gains, it's all completely 100% tax-free. And for 2026, you can put in up to $7 grand. That tax-free compounding is a game changer over the long run.
All right, we've covered the savings accounts, but that's just one part of the strategy. The next level is looking at how you earn your money and how you can start turning your everyday expenses into valuable deductions.
You know, the difference between being an employee and being self-employed from a tax perspective is like night and day. As an employee, there's very little you can deduct. But when you're self-employed, a whole world of deductions opens up. Now, there is a trade-off. You have to pay both the employee and the employer portion of CPP, which comes out to 11.9%.
So what kind of stuff can you deduct? Well, basically anything you spend to help your business make money. We're talking advertising, client lunches, your laptop, software, even a portion of your car expenses like gas and insurance. But here's the real game changer, the home office. You can deduct a percentage of your mortgage interest, your property taxes, and your home insurance. That's a huge benefit.
Now, it's not just about self-employment. Owning property, specifically rental property, can be another amazing way to save on tax. You get to deduct all sorts of expenses against the rent you collect. But there's a hidden trap here you absolutely need to know about before you jump in.
Okay, here's the deal. When you own a rental, you can claim something called depreciation, or capital cost allowance. It's a way to deduct for the wear and tear on the building, lowering your taxes each year. Sounds great, right? But, and this is the trap, when you sell that property, the CRA basically says, hey, remember all those tax breaks we gave you for depreciation? We want them back. It's called recapture, and it can create a massive, unexpected tax bill in the year you sell.
All right, let's bring it home. For our last section, let's cover a few everyday deductions and credits that pretty much anyone can claim, but so many people just forget about. You do not want to leave this money on the table.
Okay, 3 big ones to remember. First up, childcare. This is a massive one. You can deduct up to $8,000 per kid under 7. Next, medical expenses. The trick here is to pool all your family's expenses together and have the lower income spouse make the claim. It usually results in a bigger credit. And finally, donations. Don't claim them separately. Combine them with your spouse's because you get a much higher credit rate for the total amount over $200.
You know, when you look at all this, it might seem complicated. But the real secret to paying less tax isn't some crazy, complex scheme. It's not about finding obscure loopholes. It's really just about mastering these fundamentals.
So here's your checklist for 2026, your action plan. Number 1, master the basics. Make those registered accounts, your RRSP, FHSA, and TFSA, your top priority. Number 2, if you're self-employed or you have a rental, track everything, every single receipt. And number 3, plan ahead. Don't wait until April. The rule changes for 2026 are helpful, but thinking about this stuff all year long is your most powerful tool.
And there you have it. You are now armed with a solid game plan for your 2026 taxes. But remember, taxes are just one piece of your financial puzzle. So the real question to leave you with is, now that you've planned for your taxes, what about the rest of your financial future? Something to think about.